Banks are some of the most powerful institutions in the world, yet almost nobody understands how they actually make money. Walk into any bank branch, and you'll see tellers, loan officers, and customer service representatives. You'll see ATMs, deposit slips, and promotional materials for credit cards and savings accounts. Most people think banks earn their income by charging interest on the money you deposit, or by lending responsibly from a pool of existing funds. They imagine banks as intermediaries, connecting savers with borrowers, taking a small cut in the middle. But here's the truth that changes everything. Banks don't just handle money. They create money out of thin air, literally. And most of the public doesn't even realize this is happening. This isn't some fringe conspiracy theory or internet rabbit hole. It's the very system that powers modern economies. The same system that quietly transfers risk downward while keeping control and profit at the top. The same system taught in economics textbooks, yet somehow remains invisible to the average person. To understand how this works, we need to start with a simple but profound question. What is money? Most people think of money as something tangible, cash in their wallet, coins in a jar, bills tucked away in a drawer, or they think of it as numbers in a bank account, representing value they've earned through work. But banks treat money very differently. To a bank, money in your account is not actually cash sitting in a vault with your name on it. It's a promise, a ledger entry, a claim on the system, a number in a database that says the bank owes you that amount. This distinction is critical because it reveals how the entire system actually operates. When a bank lends you money to buy a house or a car, something remarkable happens. Something most people never think about. The bank doesn't reach into a vault filled with other people's deposits and hand over pre-existing cash. It doesn't transfer money from one account to another. It doesn't even check if it has enough physical currency on hand. Instead, it creates new money on the spot by simply adding numbers to your account. You get the money, the bank records the loan, and suddenly, the economy has more money circulating than it did 5 minutes ago. You didn't realize it, but you just participated in the creation of new money. Money that didn't exist before you signed those loan documents. Money that appeared because a bank decided to create it. This is called fractional reserve banking, and it's the hidden engine of our entire financial system. Banks only need to keep a small fraction of deposits in reserve, sometimes as little as 10%, sometimes even less. The rest, they can lend out. Or more accurately, they can create new loans without needing the full amount in deposits at all. Multiply this process across thousands of loans, millions of customers, and hundreds of banks, and you have a system where money grows exponentially, controlled by a relatively small number of institutions. Now, here's where it gets even more interesting. When a bank makes a loan, it simultaneously creates a debt obligation. That debt is more than just a number on a spreadsheet. It's a legally binding contract that transfers risk from the institution to the individual. If the borrower fails to repay, the bank often has multiple protections in place to limit losses. Collateral, insurance, government guarantees, legal recourse. The bank rarely loses everything and often loses nothing at all. But even when the borrower succeeds and repays every cent, the bank earns interest on money it never truly had in the first place. Think about that. The bank creates money through bookkeeping, lends it to you, and then collects interest for decades on funds that were created out of thin air. This is why banks are so powerful. They don't just move money around the economy, they create it. And by controlling who gets credit and under what terms, they effectively control the flow of the entire economy itself. Who gets to start a business? Who gets to buy a home? Who gets to expand their operations? Banks make these decisions, and in doing so, they shape society in profound ways that most people never consciously recognize. Now, this system might seem abstract when explained in theory, but its effects are concrete and visible everywhere around you. Banks influence everything: real estate prices, business growth, stock market movements, inflation rates, and even the cost of living. When banks expand lending aggressively, economies boom. Credit flows freely, businesses expand, real estate prices surge, and people feel wealthy. When banks contract lending, either by choice or by regulation, recessions happen. Credit dries up, businesses fail, unemployment rises, assets lose value, the economy shrinks. All of this is a direct result of a system the general public rarely questions or even understands. Most people experience these cycles as mysterious economic forces beyond their control. But they're not mysterious at all. They're the predictable result of how money creation works. Let's break down the mechanics step by step, because understanding the process reveals just how powerful this system really is. When you deposit $1,000 in a bank, the bank doesn't just store it in a vault with your name on it. Instead, it keeps a small fraction in reserve, let's say 10% or $100. The remaining $900 can be used to make loans. But here's the key. When the bank makes a $900 loan, that money gets deposited into someone else's account. Now that other bank keeps $90 in reserve and lends out $810. Those funds get deposited again, and the cycle repeats. Each cycle creates new money, multiplying the initial deposit across the entire banking system. Your original $1,000 deposit can eventually support $10,000 or more in loans throughout the economy. This is how money is created out of thin air. The total money supply grows far beyond the physical cash in existence. Digital ledgers, account balances, and loan agreements create money that exists only as numbers in computers. And yet, because this happens quietly behind the scenes, in bank offices and computer systems far removed from everyday life, almost nobody notices it happening. Banks also collect interest on all this created money. That means the profits generated by the system are immense and compound over time. Even when the economy contracts or individual borrowers default, the banks usually have safety nets that preserve their position. Government bailouts during financial crises, deposit insurance that protects the institution, collateral that can be seized and sold, legal protections that prioritize creditor claims. This is a system fundamentally designed to concentrate power and wealth. The risks are pushed downward to borrowers, small businesses, and everyday consumers. The rewards accumulate upward to the banks, their executives, and their shareholders. It's subtle, it's invisible to most people, and it's incredibly effective at maintaining and expanding the wealth gap. Another crucial layer in this system is the central bank. While commercial banks create money through lending, the central bank controls the base money supply and sets interest rates that influence the entire economy. Central banks, like the Federal Reserve in the United States, act as the ultimate authority in the monetary system. They set the rules that commercial banks must follow. They determine reserve requirements. They control the interest rates at which banks can borrow from each other. This ensures stability in the system and prevents complete chaos, but it also reinforces the power structure. Commercial banks operate within rules set by central authorities, yet they still retain incredible leverage over everyday people's finances, businesses, and economic opportunities. The relationship between central banks and commercial banks creates a system where money creation is controlled, regulated, and directed in ways that serve institutional interests while remaining largely invisible to the public. Let's use a concrete example to make this absolutely clear. Suppose you take out a $200,000 mortgage to buy a house. The bank doesn't take that money from someone else's deposit. It doesn't withdraw funds from a vault. It doesn't transfer existing money from one place to another. Instead, it creates the $200,000 on its ledger and credits it to your account. You spend that money to buy the house, and the seller deposits those funds into their bank. That bank then keeps a fraction in reserve and lends most of it out again. The money multiplies through the system. Debt spreads. Profit flows upward. At the same time, the bank charges you interest. On a $200,000 mortgage at 5% interest over 30 years, you'll end up paying the bank more than $380,000 total. That means the bank earns nearly $200,000 in interest on money it created out of thin air through a simple ledger entry. That's the quiet magic, or depending on your perspective, the quiet danger, of fractional reserve banking. The bank profits massively from money it never actually possessed, while you spend decades working to repay funds that were created with a few keystrokes. But the system gets even more complex and powerful than simple lending. Banks don't only create money through loans. They create sophisticated financial instruments that amplify their reach and profit potential. Derivatives, mortgage-backed securities, credit default swaps, collateralized debt obligations. These are complex contracts that allow banks to amplify profits while distributing risk to other parties, insurance companies, pension funds, hedge funds, and ultimately, taxpayers when things go wrong. The average person never sees this web of leverage and interconnection, but it defines how modern economies function at the highest levels. It's a system within a system, invisible layers of financial engineering built on top of the basic money creation process. This is why understanding the banking system is so fundamentally important. If you know how money is actually created, you start to see patterns everywhere. Real estate bubbles make sense. Stock market surges become predictable. Inflation cycles reveal their logic. Government policies show their true purpose. Wealth concentration stops being mysterious and starts being the natural outcome of systemic design. Many people never notice these patterns because they're focused on immediate concerns: paying rent, buying groceries, earning wages, managing bills. Day-to-day survival demands attention, leaving little mental space to question the larger systems at work. But institutions operate at a fundamentally different level. They don't compete on effort or hard work. They manipulate systems, control infrastructure, and leverage debt in ways that individual people can't match or even perceive. Banks don't work harder than you. They work at a different layer of reality, where the rules are different and the rewards are exponentially greater. So what's the lesson here? What does understanding banking actually teach us about power, wealth, and the modern economy? Banks are not just financial service providers. They're not just intermediaries connecting savers and borrowers. They are system architects. They control the creation, distribution, and flow of money itself, the fundamental resource that enables all economic activity. Understanding this changes your perspective on everything: wealth, debt, inequality, economic policy, and the nature of power itself. It allows you to see the invisible structures that dictate the world around you while remaining hidden from casual observation. And just like McDonald's making its real money from owning real estate rather than selling burgers, banks profit from structural control rather than individual transactions. The lesson is universal across industries and institutions. Real power flows to those who control the system, not those who simply work within it. Next time you walk into a bank, deposit your paycheck, or apply for a loan, remember, most of what you see is only the surface. The friendly teller, the clean lobby, the professional loan officer. These are the visible face of an institution whose real power operates at a completely different level. The real power, the real profit, and the real leverage happen in ways almost nobody notices or understands. In computer systems that create money with keystrokes. In complex financial instruments that multiply leverage across institutions. In systemic structures that ensure wealth concentrates upward while risk flows downward. Because banks don't just handle money. They create it out of thin air, quietly, efficiently, and in a way that ensures wealth and power remain concentrated at the top of the economic pyramid. If you understand this, you start seeing hidden patterns in almost every corner of modern finance. In real estate markets, stock valuations, government debt, corporate profits, and wealth inequality. The more you see, the more obvious it becomes. The systems around you are designed to reward those who understand and control them at the deepest level. The rest of the world simply participates without realizing it, working within a game whose rules they never learned and whose structure remains invisible. But now you know, and once you see it, you can't unsee it. The question is, what will you do with this knowledge?